welcome everyone. I hope everybody is in and doesn't have any technical difficulties on their end. We're excited to host our expert panel today to answer your pressing questions about the market, the economy, inflation, and what's ahead. So I, Grace Beckman, will be moderating this panel today, and we have members of our team that you may know, Ian Flanagan and Brooke May, on our panel. And then we're thrilled to have Jeff Killburg joining us as well. And Jeff is a regular contributor on CNBC, so he might be a familiar face. You might have seen him there every once in a while. And he's also the CIO of Sanctuary Wealth. And he spent more than 2 decades on the floor of the Chicago Board of Trade and Chicago Board Options Exchange. And he's a wealth of knowledge on all things market related. So Jeff, thanks for being here.
You bet, Grace. Glad to be here.
Yeah, and Brooke, Ian, thanks for joining us too. Thanks for being the other experts on our panel today.
Of course, thank you.
All right, a quick note, we are recording this, so it will be available on our website after the webinar. And then if you have any questions throughout the webinar, there should be a little Q&A button at the bottom of your screen. So please, if there's any questions, type those in and we will do our best to answer them as we go through. Okay, well, with that, I'm going to go ahead and kick things off with our first topic. And Jeff, I think I'm going to throw this one to you. So talking about the economy, what is your outlook on the economy? Are we in a recession? And if not, do you expect that we will enter a recession imminently?
Well, Grace, that's the question that we continue to grapple with, specifically on CNBC. And what's interesting, if you look at the technical definition of recession, yes, we are. We had 2 consecutive negative GDP quarters. And due to that data, we can argue we're in a technical recession. However, is it different this time, Grace? I think the answer is yes. So I do not believe we're in a recession. I think it's very different this time. I think the way the Federal Reserve has really come into the marketplace, COVID-19, I think the economy is stronger. And you've seen that resiliency. We talk about resiliency in the marketplace. It's really been revealed in earnings season. So I can argue both sides of the fence, and I'm not going to hedge and flip-flop like a lot of people do on CNBC. I'm going to go with the fact that we're not in a recession, despite the fact we had those 2 negative consecutive quarters in GDP. We look at the shape of the households that Americans are in, look at the consumer. I think there's a lot of data. Now, certainly, we need to see some of the data points that the Federal Reserve is looking at really reverse. But when you have the strong unemployment, the surprise unemployment that we had last week of 528,000 jobs, I think that puts a little bit of wind in the sails and also fortifies the fact that we're not in a recession, and that if we are in a recession, of course, is a rearview mirror. And GDP, by and large, Grace, is a rearview mirror look. If we do realize that that was a quick 2 quarters, then we can be out of a technical recession. So I hope that answered the question, Grace. But nonetheless, I am optimistic about the economy and the strength of the U.S. economy specifically.
Great. And Ian, do you have anything you'd like to weigh in on here as well?
Yeah, just one thing I'd reiterate on Jeff's comments, which we here at Evans Bank Wealth agree with. That technical definition of the net 2 quarters of negative GDP growth has happened. But I guess on the other hand, we've got the GDP growth, but we're also not just looking at GDP growth. We're looking at unemployment rates. We're looking at personal income levels. When you look at that non-farm payrolls job last Friday of 528,000 versus, I think the consensus expectation was like 250, so it was more than double. To us, that signifies quite a robust labor market, which should help keep the economy out of a recession. Now, I don't want to paint a Goldilocks picture here. I don't want it to come across as if we're not seeing some of the struggles that are out there. When you look at some of the underlying data in the labor market, particularly around job openings decreasing, you think about what we've heard from Amazon, all the big players, Apple, Meta, Google, they're all really freezing their hiring right now. So I think what we're going, even though we had the 528,000 number on Friday, I think what we're starting to see is a softening in the labor market, which is to be expected because of the interest rate hike. So what I would urge investors to keep in mind is it's not just about GDP growth. It's also about unemployment levels. It's also about wage growth. So it's all 3 combined.
Right. I'm going to move on to our next big topic. Probably no surprise to anybody, inflation. I think we're all tired of hearing about it, but more importantly, feeling the effects. So with that, Brooke, I might throw this one to you or Jeff. Do you think inflation has peaked, and how long will it take before prices return to normal?
Yeah, I'll take it, Grace. CPI figures continue to come in hot. In the most recent read, inflation was up 9.1% annualized. And if you strip out food and energy, it came in at 5.9%, so still very high. July numbers come out tomorrow, and we think that we're starting to see some signs of softening. The good news, I guess, is that we see some signs of softening. If you take a step back and you look at the 2-year break-even rate, which measures the expected inflation going forward, it's come down. It was almost at 5% in April, and now we're looking at 3 years, or 3% as the projection. So, it's a much more manageable figure. In addition to that, though, we know that CPI is a coincident indicator, so it takes time for lower inflation to make its way into the numbers. We're starting to see several pockets of the economy where that's pretty evident. Retail gas has fallen 20% since mid-June. And we expect there to be more downside given the disconnect between wholesale prices and retail prices. Also, goods prices are starting to come down as we see supply chain issues improve. Shipping rates for 40-foot freight containers from Shanghai to Los Angeles, they're down 40% from a year earlier. So, there are issues, though. We want to acknowledge that, shelter and services, which make up over 50% of CPI, those aren't showing signs of improvement yet. So it's going to take some time, but we're hopeful that it's getting better and moving in the right direction. Jeff, do you have anything to add there?
Well, Brooke, I believe you're correct. And it's fascinating when you really unpack the inflationary environment we are in. If we rewind, we really have to understand, and it's hard to comprehend and digest the fact that the Federal Reserve actually was creating inflation. So for them creating this inflation, that goes back to the money supply. When you talk about January 2020, the money supply was about $15 trillion with a capital T. They expanded that and moved it up to $21 trillion by November of 2021. To see that type of expansion of money supply, it was evident that they were going to get their goal, their target of inflation. And they, in essence, moved the goalpost. They wanted 2% for an inflation target. They wanted to see it run hotter. Well, they certainly got that. And now here they are with an about-face 180 degrees pullback. And that really speaks to the fact when you hear them talking being dovish or hawkish. And what does that mean? And simplistically, dovish means they're accommodative, which means they're inflating the economy. When they're hawkish, they're trying to reel it in. So what did they do? Because they control, in essence, the long end of the curve. The 10-year note was at 1.5% for quite too long, in my opinion. They allowed the 10-year note to move or really see that torque come out of the engine. The 10-year note went up to 3.5% in June. And there's definitely not a coincidence, Brooke, that we saw, in my opinion, peak inflation meet with that peak move in the 10-year note. So I believe peak pessimism, peak inflation all came into the marketplace in June. And yes, you're correct. We are seeing inflation slowly abating. It does have the ability to abate or unravel faster as we continue to see our economy transition from goods to services. And that's really been dislocated. I think you bring up a great point of talking about that dislocation. For the longest time, we thought and we had optimism that the economies were going to reopen globally. And then we had a variety of different variants of COVID-19. So it was very ebb and flow of how the actual global economy is reopening. The supply chain issues certainly amplified that. But when you see those supply chain issues being rerouted, that is short-term inflation, but that is long-term going to help us with deflation. So I am optimistic that we have seen the highest print of CPI. And yes, I can be quoted on that. And I think as we see this, the Fed's going to be in a position in September. They have a couple more CPI ratings, a couple more jobs reports, and they're going to have the ability to take a breath. But the one thing that we haven't really talked about from this inflation conversation, which I think all of us investors have learned, it's the velocity of these moves. We're not used to this. And I've been trading markets since the 90s to see this type of velocity that the Federal Reserve had to inject due to the fact of COVID-19 shutting down the whole global economy. That's where we're at right now. So when you think about inflationary components normalize, and you have to understand that the interest rate market has to really normalize first. And I go back to where I cut my teeth in the US Treasury pits at the Chicago Board of Trade. And if you understand that bond leadership, I think that helps you better understand of this velocity of the equity markets. But sure enough, the 10-year note, which did trade 3.5% in June, has now come back and is a little more tranquil of an environment. You're seeing it at 2.75. That's allowed equities to heal. It's allowed everyone to kind of catch their breath. So I think as long as we see the CPI data trending downwards, I think we're going to be in a better spot. But you're absolutely right, Brooke. Inflationary data, either surging or deflationary environments like we saw before, they take a while to work through. It's not over weeks. It's not over months. It's over a couple quarters, if not years.
Okay, so we've looked a little bit in the rearview mirror, what's happened so far, but what about moving forward? Where do we go from here? We know it was a rough start to the year. So what's the outlook for the rest of the year and beyond? Jeff, do you want to take this one, or Ian?
Go ahead, Ian. I'll let you take it out here if you want, pal. Just like I'm on CNBC, they tell me to rap a lot. Grace has been very kind and not tell me to rap, but go ahead.
Yeah, no, I caught you earlier today. You did a great job. Yeah, so I think as most clients saw in our note that we put out in the beginning of July, one of the taglines to that note was, "We're cautiously optimistic," but we are absolutely not blind to all of the various risks that are out there when we think about the markets and we think about the economy and we think about geopolitical events. So we think about earnings is kind of the one leg to the stool. Going into earnings season, which is about wrapping up right about now, a lot of pessimism in the Q2, leading up to the Q2 earnings season, really around how companies were going to be able to navigate these inflationary headwinds. And so when you take a look back now that we've seen most of the companies reported, I think 389 as of last week have reported out of the 500 in the S&P 500. We were pleasantly surprised, and I won't get into specific data points, but I think sometimes it's easier to think about tangible examples of companies that we know. So take Apple, for example. Everybody thought about Apple as a bellwether of the not only the U.S. consumer, but the global consumer. And we think about where Apple has a lot of its revenue exposure. One area is obviously China, a lot of iPhones being sold in China. So going into Q2 earnings season, the expectations, I believe, were that China's revenue as a region for Apple would be down 7%. A lot of that had to do with what Jeff mentioned earlier, this kind of not one big global reopening of the economy. In fact, we realized that different countries treated COVID differently, China being the most restrictive. So for most of the quarter, China was on total lockdown. And so everybody thought that, oh no, here we go. Apple's going to have a horrible report because they're not going to be able to sell any iPhones. Well, actually, that wasn't the case. And Apple's management, some of the best in the industry, was really able to navigate those lockdowns and basically had hardly any impact on the revenue in China. And if you look at Amazon, another big name that we know, and you think about inflation and how it impacts Amazon, well, it impacts them in fuel, trucks, transportation, labor. And so they made a conscious effort after the prior quarter to really focus on not hiring any more, increasing productivity. And Amazon had a very surprising report. So a lot of these big names, which you view as bellwethers for the economy, actually had beats to the upside and rosier guidance than what we would have expected. We already touched on inflation as obviously another risk looking forward. We're seeing some softening. And of course, inflation then dictates whether or not the Federal Reserve will continue to hike, and whether they'll hike more or less than we thought. So our expectations are kind of the 3.5 to 3.75 by the end of the year. If we start to see some softening in the economy or softening in the inflation data, that might come down. That could actually be a tailwind to the market. Conversely, if the economy, inflation continue to roar hotter than expected, we may see a little bit more rate hikes than expected, which would be a headwind to the economy. We're also thinking about some of the more geopolitical events around Russia and Ukraine, now China and Taiwan. So those are obviously top of mind for us. But so far, when you think about where the markets have been we were down going into July. The S&P 500 was down about 20%. NASDAQ was down almost 30%. From July 1st until yesterday, S&P 500's up, 9.5%. Dow's almost up 7%. NASDAQ was up almost 15%. So we've had some nice green shoots over the last five or so weeks. So we're cautiously optimistic on the second half of the year, but by no means does that mean that it's going to be smooth sailing. We expect a lot of volatility to continue.
Well, Ian, I think you bring up a great point. And just to jump in here for a second, when you talk about the last 5 or 6 weeks, this healing, I think it certainly is predicated due to the 10-year note capitulating and touching 3.5%, now pulling back. When those yields come down, it really has a dramatic effect on housing, and it also has on spending habits. And if you think about the consumer is in a very different spot. So where my outlook is a little bit more positive, I was on Larry Kudlow's radio show about 5-6 weeks ago at the same time when I called the market bottom on his show. He thought I was too optimistic, but I'm optimistic, or cautiously optimistic, like you stated, due to the fact that I think we have a lot of the headwinds coming at us, but we also have some offsets. If you look at inflation, which is absolutely terrible. I mean, no one enjoys the pain at the pump. When you talk about where we're paying more and more for food and energy, despite the fact that the Federal Reserve doesn't use food and energy into their metrics. But you think about the strength of the US dollar. It's one thing that's not talked enough about, and not to get too deep into the weeds, but that strength of the US dollar is actually giving the US consumer more power. If you're taking a European vacation, if you're buying things overseas, there is. So yes, you're right. Absolutely, Ian, to talk about the earnings and the forecast and that lowered bar. But here we are, they're navigating a stronger dollar. They're navigating inflation. So when you see that resiliency in these S&P 500 companies, some of these blue chip tangible names, that really makes me feel a little bit more confident that we have the ability to overcome these significant headwinds. And when you talk about the 10-year note, the Fed, I believe, I'm going to make a bet always on the fact that they're more dovish than hawkish, simply meaning that they're going to stay accommodative. And the one thing we talk a ton about on CNBC, but not enough in my opinion, is their balance sheet. Their balance sheet is $9 trillion. That's double the size. It was $4.6 trillion before COVID. And if we go back, if anyone remembers before the Great Recession, their balance sheet was about 450 billion with a B. So this massive expansion of their balance sheet kind of provides a liquidity component, but also a safety net. So I do believe that the market is going to continue to be volatile. I'm not saying we're out of the woods, and volatility is really important to remember, because volatility makes markets move down, but also up. So we just saw this velocity move the markets back up. My future outlook when I talked about the halftime back in the end of June was that we have the ability to claw back all the losses this year. And there were substantial losses, to your point, when you talked about how deep those bear territories were specific to the NASDAQ stocks. But they were also long overdue, in my opinion, for a repricing. And I think that's the big component where a lot of your smart investors, your clients, know that repricing doesn't happen over a couple of weeks or a couple of months. This takes a while. If you look back in the 80s and 90s and even the 2000s, this repricing is just a longer cycle. So here we are with just a lot more velocity in the marketplace. But I do remain cautiously optimistic. I think you have to be considerate at the end of the day of what stocks you own, what sectors you own. And you guys do a tremendous job of finding strength and avoiding weakness. So kudos you, and a hat tip to the whole crew there. But I think the volatility is going to continue, but I think you will see the markets continue to float higher. And that may catch some people either underinvested or even short in the marketplace. And that, I think, has more momentum the upside, and it's underappreciated in today's current market prices.
Jeff, Ian, thanks for weighing in on that. So I know we looked ahead a little bit, but let's zero in specifically on November. It's a midterm election year. So we've been hearing a lot about this and how it's affecting the markets. And just a quick little teaser, we're actually going to have another webinar in October with Michael Townsend, the head of legislative and regulatory affairs to Schwab, to talk exactly about this. But Jeff, why don't you give us just a little glimpse of how you think about midterm elections, especially in the context of the markets?
Sure. Well, Grace, Brooke is a lot smarter than me, so you probably want her
or Brooke,
to go
whoever
first.
wants to take it.
I hand the ball off to Brooke, because she is smarter than me.
I mean, when it comes to elections, there's a lot of uncertainty. We see the numbers now, but in time, we know that those can change, and a lot can transpire in a very short period of time. As we look since 1974, the president's party has lost on average 23 congressional seats in the midterms. But that number's been higher in recent midterms with the White House and Congress being controlled by a single party. In 2006, Democrats picked 31 seats. In 2010, Republicans gained 64 seats, and it goes on and on. So, by all accounts, we very well could end up with 2023 having a divided government, which has actually been viewed as a positive for the markets. The markets don't like uncertainty. So we typically see higher volatility and lower returns leading into elections. However, go ahead.
Sorry, no, I just want to jump in. I think one of the interesting things, just to piggyback on that, is that comment from Jeff about volatility and what we're going to see or may very well see in the second half of the year. It's interesting if you look at all of the midterm elections charted out, and you look at average annual returns by quarter in the midterm year and then the following year, what you'll see is actually in quarter two, I think the market's down on average about 2%. This is quarter two, the midterm year. Quarter three, it's down by like 0.5%. So let's just call it flat. But then what ends up happening is once you start getting more clarity on election, and really it's not so much about who's in office, it's the policy, right? But when you start getting clarity on the policy, quarter four of election years, that average goes up to plus 6%. And then quarter one of the following year, so this is post midterm election, it's plus 7.5%. And then it starts going down a little bit, it's plus 4.2%. So I kind of geek out on the data, and I think that's interesting. But I think it would be misplaced to draw a causal effect from that data, right? So in every single one of those years that goes into the averages, there's all sorts of macroeconomic things going on, just like we have this year. So I mean, it is instructive, but it's not directly causal in the sense that if we're absolutely going to have these sorts of returns. So I look at that and I think, okay, that's what history shows, but then there's all these other issues going on that you need to factor into your investment decisions.
No, if I could jump in quickly too, because I am a financial geek at heart. When you talk about the midterm election year, you're absolutely right. Those first three quarters, very volatile. Typically that certainty, either on the left or right side of the aisle, that certainty comes in and you see the returns come in. But what's fascinating about that data, we must have been reading the same thing here, Ian, is that you go back 85 years, the average S&P 500 return was 6.5% on average for those 85 years. But the year after that midterm election year, once that certainty, that tangible certainty you talked about comes into the marketplace, you see the return on average more than double. It goes up to 15.1%. So when people talk about recession, are we in a technical recession? Are we going to be heading into recession? I take a bit of solace, and of course, past performance cannot predict future results, but I take a little bit of solace in the fact that we've never really seen that type of recession the year after a midterm election year. So 15.1% on average the year after midterm election for the last 85 years. I like that data, Ian.
All right, Jeff, you teased this a little bit earlier, but I'm going to switch topics and talk about portfolios and investment strategies. So given everything we've discussed from recession to inflation and the midterms, how do you position portfolios in this environment? How about you weigh in a little bit high level? And then Brooke, I know you might weigh in specifically with Evans May Wealth and what our strategy is here.
Sure. And I think you guys do a tremendous job of really assessing and understanding exposure, very different than most wealth management teams. And if you talk about the exposure you have going in this year, you guys did a great job of understanding as interest rates were moving that there was going to be a wrestling match between growth and value. Certainly the blue chip tangible names have come back to life. You talk about an IBM, you talk about ExxonMobil, you talk about some of these names that kind of gotten forgotten about during the FANG stocks, all the years of the FANG stocks. But I think at this moment in time, in the last couple of quarters, it's made a ton of sense to understand your exposure. We do believe that having exposure to sectors revealing strength and staying away from sectors with weakness does allow you to have a better outcome, a portfolio better outcome. But when you also talk about interest rates and understanding that bond leadership, I think that's been critical for in the portfolio management role that I play, is understanding how are those interest rates going to not only affect individual stocks, but also sectors as a broad. And I think as we consider about how to reposition, how to tax loss harvest, how to consider what are we going to do moving forward with our portfolios, I think that's a critical component. But again, I'm preaching to the choir. You guys do a tremendous job of understanding how to rebalance, how to tax loss harvest and reposition. And doing that last year, that was the time to do it when you saw growth really, you saw a lot of profit taking in growth. You saw a lot of consideration as the interest rates were still at 1.5%. That allowed all of those tech stocks to really have their heyday. And as soon as you saw those interest rates reposition or normalize, you did see the NASDAQ 100 down over 30% year to date in that repricing. So we continue to look at opportunities of rebalancing, tax loss harvesting, and repositioning for outcomes that we believe are cautiously optimistic.
Brooke, anything you'd like to add on?
Yeah, specific to our client portfolios, we focus on high quality companies and a balance to the portfolios. Most of our portfolios have dividend paying stocks, and they help cushion volatility and generate some income during times of volatility. And it's also helpful during periods of higher inflation. We also have the exposure to some of the big technology companies. And, when you look at those companies like Microsoft being down 20%, Amazon being down 27% from the all-time high, Google down 23%. So there's some opportunities here. They're good companies that have consistent sales. They're growing companies, and they won't be down forever. And so, we're comfortable holding those positions, having conviction in the strategy behind those positions, and sticking with quality companies, not speculative companies, knowing that in time, the market always comes back. We're also starting to look at fixed income again. Yields have been paltry, to say the least. And, we're starting to get back to corporate bonds yielding around 4%. So, as time goes on, we'll continue to tweak and monitor the portfolios and make changes as needed. But overall, our clients should rest assured knowing that we've got quality companies in the portfolio that are going to stand the test of time and make money in the long run.
Ian, any final parting thoughts? I know we're at our 30-minute mark, so if you have anything else you'd like to say, I know, Brooke, I couldn't have said it better myself, but Ian, I'll give you the floor if you want to have any final thoughts before we wrap this up.
I think that, obviously the first 6 months of the year have been difficult, but the market's always forward looking, right? And so all of the, when the market started selling off in January, it saw what was coming ahead, and then we lived through it, and now the market's starting to come out of that. And so I think most of the clients understand that, and it's difficult at times to see the volatility in the portfolio. But to Brooke's point, we've got these portfolios constructed in such a way that they're balanced, and depending upon the market cycle, the economic cycle, they're constructed in such a way that the goal is really to generate returns, but really to reduce risk. So that's the way we think about things. And so as difficult as the first half of the year was, we're already starting to see 5 weeks into the second half of the year, the market's rebounding a little bit. So just hang in there, and we're like we said, we're cautiously optimistic for the rest of the year.
All right. I think that is a great place to end. First and foremost, I want to thank everybody for joining us today, and then our expert panel, Ian, Brooke, and then especially Jeff Killburg. Thank you for joining us. We appreciate everybody sitting in, and hopefully this was insightful. If you have any follow-up questions, you can always reach out to us at Evans Bay Wealth, and then this will be posted on our website as well. So thank you to our panel. Thank you, Jeff, and thank you everybody who joined us today.